Welcome, ladies and gentlemen. My name is Peter Yusuf. I'm the senior analyst of IronFX. Together we'll be going through a discussion about the week ahead in the financial markets, with focus being on the FX market. Now, before we start, allow me to show you our risk warning and our disclaimer. And as you are reading, let me make a small intro here. Now, maybe the main characteristic data of the past days was the release of the US CPI rates, which showed how hot inflation was in October in the US. The release created turbulence in the markets and provided considerable support for the USD. In the coming week, we continue to get a large number of high-impact releases, which could foreshadow an interesting week ahead. On Monday, we note the release of Japan's GDP rates for quarter 3 and China's industrial output growth rate for October, both in the Asian session. On Tuesday, we get UK's employment data and the US retail sales growth rate for October. On Wednesday, we note Japan's trade data as well as UK's and Canada's CPI rates, all of them being for October. On Thursday, we get from the US the weekly initial jobless claims figure as well as the Fed business index, which is a little bit more forward-looking as it's for November. And on Friday, we get Japan's inflation data for October, UK's retail sales for the same month, as well as Canada's retail sales for September. On the monetary front, we have planned speeches of policymakers from around the world, while tier-wide traders may be keeping an eye out for CBT's interest rate decision on Thursday, while earlier on Tuesday, RBA is to release the minutes of its November meeting. Now, with no time to waste, let's move to the US dollar, and this would be the USD Index for our chart. A clear rise of the US dollar in a buying trend, practically getting substantial support from the release of the US CPI rates for October, and has broken above the 95.10, albeit some stabilization seems to be taking place. We tend to maintain a bias for an upward motion, given also that the RSI indicator is above the reading of 70, which on the one hand implies that there is a strong bullish sentiment, on the other though may imply that the US dollar has been overbought and a correction lower could be in the cards for the index. To the downside, we would note the 95.10. Lower than that would be the 94.60, which was practically aimed for twice. Even lower than that was the 94.10, which provided considerable support around the beginning of October, from the 7th to the 11th. To the upside, we note the 95.60, the 96.15, and the 96.65. Please note that the index is practically considerably high. It has not reached such levels since July 2020 last year. Moving now to USD's fundamentals. Now, after the USD got considerable support from the release of the US CPI rates for October, the greenback is about to end the week higher against its counterparts. As we have mentioned, it's characteristic that the USD Index reached such high levels that have not been seen since July last year. It should be noted that October CPI rates accelerated beyond the market's expectation, and the headline rate reached levels not seen since November 1990, underscoring the inflationary pressures the US economy is going through currently. Market pressure intensified on the Fed to tighten its monetary policy at a faster pace in order to curb the red-hot inflation. San Francisco Fed President Daly had stated earlier in the week that she expects supply chain constraints to be maintained, yet price pressures to moderate as we get through the pandemic. Yet the Fed's narrative of the temporary nature of inflation seems to weaken, especially after Wednesday's release. On a fundamental level, the easing of tensions in the US-China relationships is well noted after the surprise joint announcement of the US and China that they will collaborate to curb emissions. Should the easing of tensions in the relationships of the two economic superpowers continue, we may see some safe haven outflows for the USD. Yet that not may be in the market's attention for now. Please note that there is a chance for US President Biden and Chinese leader Xi to actually make a joint statement to the leaders of the countries of the Pacific Rim, and should the easing be maintained, that could create substantial headlines, practically or mostly if you prefer, on Monday. As for financial releases, next week we note on Monday the New York Fed manufacturing for November, and we highlight on Tuesday the 16th the release of the US retail sales growth rate for October, as well as the industrial production growth rate for the same month. On Wednesday the 17th we note the release of the US construction data, that's the house starts and the building permits, for October, and on Thursday the weekly initial jobless claims figure and the Philly Fed business index for November, as we have mentioned before. Moving now to the pound, and this would be GBPUSDs for our chart. In a clear downward motion, and we tend to maintain this bearish outlook for the pair. Please note that the RSI indicator is at the reading of 30, once again also implying a bearish sentiment. To the downside, we would note the 1.3290, the 1.3185, and the 1.3080, while to the upside, which has wider spaces between the resistance lines, we would note the 1.3430, which practically provided support twice here, but as it has been broken, has now switched to a resistance line. Higher than that would be the 1.36, which provided considerable resistance and capped the pair's upward motion around the 10th of November. Higher than that would be the 1.3750. Moving now to the pound's fundamentals. The pound is about 20 week lower against the USD, yet seems to maintain a marginal movement against the Euro and JPY. Soft GDP rates released on Thursday for Q3 and September did not help the pound. On the contrary, may even have weighed a bit. It's characteristic that the UK economy grew less than what BOE had expected, and that may also weigh a bit on the monetary outlook. Nevertheless, currently on the monetary level, there seem to be expectations by the market for the BOE to maintain rates unchanged in its next meeting, which could weigh on the pound. Yet the majority of the market seems to price in that the bank will actually proceed with a rate hike. On a fundamental level, the tensions in the relationship of the UK with the EU could weigh on the pound should they escalate further. On the political front, the UK government is fighting sleaze allegations by the press, which could also weigh on the pound should the headlines intensify. As for financial releases next week, GBP traders are to have a busy calendar, as on Tuesday we get UK's employment data. On Wednesday, UK CPI rates for October are to be released. And on Friday, we get UK's retail sales growth rates also for October, all of them being high impact financial releases. Moving now to the Japanese yen, and this would be USDJPY for our chart. Now, the pair has risen, yet seems to be stabilizing, or at least seems to have such tendencies in the past 24 hours. We tend to maintain a bias for a sideways movement currently between the 114.45, which is our first resistance line, which provided considerable support a couple of times. Higher than that would be the 115.20 and even higher the 116. To the downside, besides the 113.70, which provided support twice here, was also a resistance line further back the line. We also note the 112.90, which practically withheld the drop of the pair. That was around the 8th to the 9th of November. Lower than that would be also the 112, which provided resistance back in the end of September, the last days of September, and has now been turned into support line as the pair's price action has moved upwards. Moving now to JPY's fundamentals. Now JPY is about to end the week weaker against the USD and less against the pound, but not against the euro. On JPY's fundamentals, we note that the pandemic has retreated to minimal levels as a positive for the process of reopening the Japanese economy. On the flip side, supply shortages seem to continue to torment the Japanese manufacturing sector primarily and could slow the economic recovery as exports and economic activity in the sector could suffer. Also, on a fundamental level, we expect JPY to continue to be influenced by safe haven flows in the coming week as well. Fiscally, we should note that Japan's PM Kishida stated on Tuesday that the government is making a stimulus package to achieve a virtuous cycle for growth and distribution of wealth. Now, should the package be actually sizable, it could provide some support for JPY as it could promote inflation as well as growth for the Japanese economy. As for financial releases, we highlight on Monday, the 15th of November, the release of Japan's GDP rates for quarter 3. On Wednesday, the 17th, we get from Japan October's trade data, as well as the machinery orders growth rate for September. Last but not least, we also highlight the release of Japan's CPI rates for October on Friday, the 19th of November. On a monetary level, we should bear in mind that BOJ policymakers stressed the need for the bank to maintain its ultra-loose monetary policy in place, as inflation seems to rise moderately. The above were published in the release of the bank's summary of opinions for its latest meeting, and overall we see the case for BOJ's dovish stance to weigh on JPY as interest rate differentials may widen adversely for the yen side. Moving now to the common currency and EURUSDs for our chart. Note how there has been a wide drop of the pair, and actually the pair's price action is now teasing the 1.1445. We tend to maintain a bearish outlook for the pair, albeit we should note that a correction higher could be in the cards for the pair, given that the RSI indicator below the 4-hour chart is below the reading of 30, which may imply that the pair is oversold. Now, as a support line, we note the current level at the 1.1445. Lower than that would be the 1.1370, and even lower, the 1.13. To the upside, we would note the 1.1520, which provided support a couple of times in the past and could be considered also resistance as the price action has now turned lower and turned into a resistance level. To the upside also, we note the 1.1615, which provided resistance numerous times in the past months. And higher than that would be the 1.1690, the highest level in the chart, which provided resistance that actually capped the pair's upward motion around the 27th to the 28th of October and further back near the last days of September. Moving now to the common currencies fundamentals. Now the euro is about to end the week lower against the USD, obviously, while also edges lower against the pound and JPY. The path of the pandemic is once again worrisome for the zone, and especially Germany. The number of daily cases in the largest economy of the Eurozone has reached record high levels by surpassing for the first time 45,000 on November the 10th. The situation seems to be under control in other major member states like France, Italy and Spain, at least for now. On the other hand, the energy crunch as well as supply shortages may still be big issues clouding the economic recovery of the zone. On a monetary level, we highlight ECB's dovishness. We emphasize ECB's chief economist Philip Lane's comments in the previous days, stating that, quote, an abrupt tightening of monetary policy today, unquote, may not counter high inflationary pressures, yet could slow down the economy's growth. Practically, that would imply that a possible hike of rates could prove to be counterproductive. Overall, inflation is still being seen as temporary by the bank and not a chronic problem, which implies a continuation of its ultra-loose monetary policy and could weigh on the euro's horizon. As for financial releases, we note Eurozone's second estimate of the GDP rate for quarter 3, that's on Tuesday the 16th, and October's final HICP rate for the area on Wednesday the 17th, as well as Germany's producer prices growth rate for October on Friday the 19th of November. Moving now to the Australian dollar, and this would be AUDUSDs for our chart. Now the pair is still in a downward motion despite the correction upward, which has been ongoing practically since the late Asian session today. We would consider switching the downward bias, or the bearish outlook if you prefer, should the pair actually break above the downward trend line and the 0.7310. Now, specific levels to keep an eye out would be the 0.7310, which we have noted before. Higher than that would be the 0.7365, which practically acted both as a support line, that was around the 5th of November, but also as a resistance line, and that was around the 11th to the 12th of October. Higher than that, we also note the 0.7420, which capped the pair's upward motion once and twice here, while also provided support around here. So both of these levels are considerable, and traders seem to take notice of them. To the downside, we note the 0.7230, which held its ground against the downward pressure of the pair's price action around the 5th to the 6th of October. Lower than that would be the 0.7170, which held its ground on the 29th of September, and even lower than that would be the 0.7110. Moving now to the Aussie's fundamentals. Now the Aussie seems about to have another week in the reds, and that's back to back against the USD. The release of Australia's employment data for October on Thursday's Asian session did not help much, as they remained soft. It should be noted that the employment change figure failed to get out of the negatives, while the unemployment rate rose, underscoring the softness of the Australian employment market and actually disappointing Aussie traders. Thus, RBA's determination to postpone any rate hikes until 2024 may intensify. Please note that on Tuesday, the minutes of RBA's latest meeting are to be released, and should a dovish tone prevail, we may see the Aussie slipping. On Monday's Asian session, we note the release of China's industrial output growth rate, which could be of interest for Australian exporters of raw materials, while also the retail sales growth rate for the same month could be an interesting read, as there have been signs that China's internal demand levels may have lowered. On Wednesday the 17th, we note the release of Australia's wage price index for quarter 3, and should rates accelerate, we may see the Aussie getting some support, as it could imply some inflationary pressures within the Australian economy and vice versa. On a fundamental level, we note that a possible thawing of the tensions in the US-China relationships could have positive effects on the Aussie's price, while also a positive market sentiment could prove beneficial for the commodity currency. Moving now to the Canadian dollar. USD CADs for our chart with a steep rise, practically breaking the 1.25 and the 1.2580 before stabilizing somewhat just above the S1. Now, we tend to maintain a bullish outlook, and for the time being, we consider this stabilization over the past 16 hours as rather temporary, and for actually switching towards a bias for a sideways motion, we would require more candlesticks to verify that sideways motion before switching. Nevertheless, to the upside, we note the 1.2645, which provided resistance around the 6th to the 7th of October. Higher than that would be the 1.2710, which seemed to cap the pair's upward motion around the 4th of October, but also earlier in September. And the highest level noted in the chart would be the 1.2775, which reversed the upward motion of the pair around the end of September. To the downside, we note the 1.2580, which also provided support around the beginning of October. Lower than that would be the 1.25, which was prior resistance line, now turned into support. And even lower than that would be the 1.2425, which provided considerable support in the past week. Moving now to CAD's fundamentals. CAD's weakening against the USD seems to continue for a third week in a row, and it's characteristic that each week passing, the drop is being wider. On CAD's fundamentals, we note the unexpected swings in oil's prices. It seems that oil prices were affected by drawdowns and the buildup of US inventories, yet also from the possibility of the US government actually using some of its strategic oil reserves in order to curb the commodities prices. Now, overall though, it seems that oil's prices are in a downward motion for the past few days, which may have also weighed somewhat on the loonie. For more on oil, feel free to go through our oil report, which was released yesterday. On the monetary front, BOC's confidence seems to be maintained, given that no signs for the opposite were present in the past few days. On the contrary, it's characteristic that BOC Governor Tiff Macklem once again assured Canadians that the bank is going to keep inflation under control, while he also stated that inflation is to be transitory, yet not short-lived. So some tendency for inflationary pressures to be maintained is expected, and the bank plans to keep them under control. As for financial releases, we note on Monday the release of the growth rates for manufacturing sales and wholesale trade for September. On Tuesday, we highlight the release of Canada's CPI rates for October, which could prove to be the main release of the week for CAD traders. While on Friday, the 19th, we get the retail sales growth rate for September. Now, before we close, and as a general comment, we may see the USD relenting some of the initiative to other currencies, given that high-impact financial releases are more evenly spread among economies, providing a blend for traders. US stock markets tended to retreat after the release of the US CPI rates, and worries about the Fed's intentions seem to be on the rise. A digestion of the release and an improved market sentiment in the coming week could help stock market indexes aim for new record highs. As for gold, we must note that the release of the US CPI rates has disrupted the negative correlation of gold and the US dollar, allowing practically for both instruments to rise simultaneously, as gold is considered as a hedging instrument for inflation. Last but not least, we would like to make a small comment on the interest rate decision of the Central Bank of Turkey on Thursday the 18th. Now, inflation in Turkey has accelerated further for October, and one could expect that the bank should start tightening its monetary policy. Yet, on the other hand, Turkish President Erdogan seems to be still pressing for the bank to lower rates in order to boost the recovery of the economy. The whole situation resembles a negative spiral, and should the bank proceed with another rate cut, we may see the TRY weakening once again. That should sum it up for the week. From all of us here at IronFX, best wishes for solid trading.